The salad oil scandal, how a tank of lies shook Wall Street in the early 1960s.
Ow.
Wall Street was a place built on trust. Banks trusted brokers, brokers trusted middlemen, and middlemen trusted ambitious traders who promised fortunes in commodities, like soybeans, cotton, and edible oils. On paper, it was a booming system, spinning endless wealth out of barrels and contracts. But in 1963, single man would expose just how fragile that trust was with one of the most audacious frauds in financial history. This is the story of Anthony Tino DeAngelis, a Bronx-born hustler who tricked America's biggest banks, brought American Express to its knees, and almost collapsed Wall Street itself, all with nothing more than tanks of water and a thin layer of salad oil. Anthony DeAngelis didn't look like a Wall Street titan. He was a burly, streetwise businessman, the son of Italian immigrants who grew up during the Great Depression. But what he lacked in pedigree, he made up for in ambition and an uncanny ability to bend rules. His beginnings weren't glamorous. He started as a small-time broker in the Bronx, selling cooking oil and groceries to local shops, but he had bigger dreams and an even bigger appetite for risk. By the late 1950s, DeAngelis had already run one shady business into the ground. His meat supply company had been caught cheating the government during a school lunch program, selling substandard beef to public schools. It was a scandal that should have ended his career. He was fined and disgraced, labeled as untrustworthy and shunned by honest businessmen. But instead of disappearing, DeAngelis reinvented himself, pivoted into a new industry, commodities. Why edible oils? Because they were everywhere. Soybean oil, cottonseed oil, corn oil, these were the building blocks of America's booming processed food industry. Margarine, salad dressing, snacks, and frozen meals all depended on these oils. And unlike meat or produce, oil could be stored for months in giant tanks without spoiling. That made it the perfect asset to borrow against. Two bankers, barrels of oil were as safe as gold bars. You could see them, measure them, and lock them away. What could go wrong? By 1959, DeAngelis had founded the Allied Crude Vegetable Oil Company in Bayonne, New Jersey. It was a sprawling facility filled with storage tanks that looked impressive from the outside. On the surface, Allied appeared legitimate, but underneath the entire business was built on deception. DeAngelis was addicted to leverage. He needed constant cash to fuel massive trades, and for that, he needed banks willing to lend him millions, secured by his oil reserves. And here came the genius and the fraud. DeAngelis realized he didn't actually need millions of gallons of oil to borrow millions of dollars. He only needed the illusion of oil. His trick was deceptively simple. He filled his tanks mostly with water, then poured just a few feet of vegetable oil on top. Because oil floats, inspectors dipping into the tanks would only sample the oily surface. The sticks came up slick with oil, and inspectors were convinced the tanks were full. It was the perfect con. Inspectors from American Express and other firms signed off on his tanks without digging deeper. Warehouse receipts certified Allied's inventory, and those receipts were as good as cash on Wall Street. With a few clever tricks, DeAngelis turned a handful of oil into an empire. By 1962, he had perfected the scam. Allied claimed to control more than 1.8 billion pounds of oil, almost half the nation's supply. More than 100 banks and trading houses bought into the illusion, lending him staggering sums. Giants like Bank of America, Chase Manhattan, and Merrill Lynch were eager to do business with him. Even American Express had its name stamped on his inspection certificates. To them, DeAngelis wasn't a hustler. He was a rising star in the booming commodities market. But behind the glossy numbers, Allied was a house of cards. The tanks were mostly water, the receipts were worthless. The empire existed only on paper. The illusion began to crack in late 1963. Prices in the soybean oil market began to fall, putting pressure on Allied's trades. Some partners grew, suspicious of DeAngelis's vast reserves. How could one company really control so much oil? When inspectors finally drilled deeper into the tanks, beyond the oily surface, they made a chilling discovery. The tanks were not full of oil at all. They were filled with millions of gallons of seawater. The discovery triggered panic. By November 1963, the fraud was undeniable. Allied Crude Vegetable Oil Company was insolvent, and its empire was exposed. As a sham, banks and brokers realized the collateral backing hundreds of millions in loans simply didn't exist. Losses totaled more than $180 million, equivalent to over $1.7 billion today. The fallout was immediate. On Wall Street, trading floors descended into chaos. Phones rang endlessly as brokers tried to unwind deals. Clerks screamed across the floor. Tickers rattled out streams of collapsing prices. Firms that had trusted DeAngelis were suddenly staring at catastrophic losses. Confidence evaporated. Some feared the entire commodities market might collapse. The scandal hit American Express the hardest. The company had guaranteed much of DeAngelis's credit. Overnight, its stock price was slashed in half. Investors rushed to dump their shares, terrified the company would go under. Newspapers splashed bold headlines. Salad oil scandal rocks Wall Street. Shareholders protested outside American Express offices demanding answers. For a moment, one of the most trusted financial names in America looked like it might vanish. Anthony DeAngelis himself was paraded as the villain of the decade. In November 1963, FBI agents raided his offices, uncovering doctored receipts falsified, inspection reports, and meticulous notes on his elaborate scam. Days later, he was arrested, charged with fraud and conspiracy, and thrown before the courts. He tried to portray himself as a bumbling businessman who had simply gotten in over his head. But prosecutors painted a different picture. A man who had knowingly deceived hundreds of banks, orchestrated one of the largest swindles in history, and almost dragged Wall Street into collapse. He was convicted and sentenced to 7 years in federal prison. The scandal left behind not only financial wreckage, but also a surprising twist. For American Express, the salad oil scandal was nearly fatal. But where others saw disaster, a young investor named Warren Buffett saw opportunity. Alongside his partner Charlie Munger, Buffett studied the situation carefully. Yes, American Express had been humiliated. Yes, it had lost millions. But its underlying businesses, credit cards and travelers' checks, remained profitable, entrusted by millions of customers. Buffett believed the panic was temporary, and that American Express's brand was strong enough to recover, so he made one of the boldest moves of his career. Buffett invested nearly 40% of his entire investment partnership into American Express stock while it was at rock-bottom prices. His bet looked reckless at the time. Critics mocked him for throwing good money after bad. Within a few years, American Express had bounced back. Its credit card business boomed, travelers' checks remained dominant, and Buffett's stake multiplied in value. The very scandal that had nearly destroyed American Express had launched one of Buffett's greatest long-term holdings. To this day, Berkshire Hathaway still owns a massive stake in Amex, a legacy of a bet born out of fraud and panic. The salad oil scandal left scars, but also lessons. Inspectors and regulators learned that trust is not enough. You have to verify what lies beneath the surface. Banks learned that blind greed can cloud judgment. Dozens of institutions ignored red flags because they didn't want to miss out on profits. And investors learned that every crisis, no matter how devastating, creates opportunity. Anthony DeAngelis was eventually released from prison, but he never regained his former glory. He faded into obscurity, remembered only as the man who filled oil tanks with water and nearly brought Wall Street to its knees. But the legacy of his fraud is still felt today. Regulations tightened, oversight improved, and the scandal became a cautionary tale studied by business, schools, and investors alike. It's almost absurd to think that a few layers of oil floating on water could shake the foundations of American finance. Yet that's exactly what happened. In 1963, the fraud was simple, but the consequences were massive. Billions of today's dollars vanished. Trust was shattered, and an entire industry was forced to rebuild. So the next time you hear about a financial crisis, remember this. Sometimes, the biggest disasters don't come from complex algorithms or exotic investments. Sometimes they come from something as simple as oil floating on water and the blind faith of people who never bothered to look beneath the surface. This was the untold story of the salad oil scandal, one of Wall Street's biggest cons.